So, hi everyone. I'm Alice Chen. I'm a partner at Pender Hastings Capital. I'm here with my business partner, James Livingstone, and our operating partner, Shane Carter. We're very, very happy to have this opportunity to do a deeper dive with Shane. I've known Shane for about a year. He's an outstanding human and just a great person, a great business operator, a great, great business leader. So, yeah, so Shane, just to get us started, why don't you tell us about your journey? How did you get into land development? Tell us about yourself, your career path, your path in real estate, and how you landed here.
All right, sounds good. Well, good to be with you and James, Alice. And so I'll start from the beginning. My path was one of really understanding that I've always been a real estate guy for 27 years, and I started really at the very bottom of what we do in development, which is I started just rehabbing houses and fixing them up and selling them for a profit. And that process led me to really understand that I enjoyed the process of creation. And so I started a general contracting firm where I became a single family home builder and built starter homes at first. And then I built middle market homes. And as I progressed through my career, I moved on to multi-million-dollar luxury homes, as well as townhome communities, mixed use communities, condominiums, et cetera, building my capacity as a developer. About midway through that journey, I understood and started to incorporate land development into my practice, taking raw land, getting it entitled and approved, getting the site-specific engineering completed, building the roads and infrastructure, building the homes, selling through the community. So that was my journey in real estate development. And then I always took the money that I made in those transactional businesses and invested it in multifamily assets and commercial real estate and more passive income investments that I could place that capital into. And so we've done close to 700 million or so in assets over the last 20 years, and that's a component of our business now as well, in addition to this horizontal land practice that we have.
Okay, amazing. And so, recently land development has been getting more attention. To me, James and I have been studying different strategies in the US. James spent the entire year of 2022 digging into value add multifamily in Dallas. So it seems like land development is kind of the next big thing in real estate investing, but it's kind of a not super well-known area. Can you tell us why this is and why it's something that we should pay attention to?
Yeah, absolutely. Well, there's a few things. I'll first answer the question from the macro perspective of, why is this an intelligent place to invest? But I also want to go into a little bit about, why we're positioned here. And so from a macro perspective, we continue to have a severe market imbalance relative to supply and demand for housing in general. We continue to be dramatically undersupplied in housing. And we can't catch up to the demand. And so there's a massive tailwind of production in homes. Most analysts and economists place the number somewhere in the 3 to 4 million range in terms of number of homes that we are short. And so on an annual basis, we generally need to produce about 1.1 to 1.2 million to reach a homeostasis in the market. In other words, to reach just the annual demand of household formation, net migration patterns, and housing demand. So in order to chew into that 3 million, let's call it on the low end, of additional supply, we would need to produce 1.6 to 1.8 million homes per year. And that would take 5 to 6 to 7 years to be able to eat into that dramatic shortage that we have. The problem is that we can't entitle enough land, and we can't develop enough land, and we can't develop enough housing to get much beyond this sort of 1.3 to 1.4. So we're kind of stuck in this, maybe we can oversupply 200,000 to 300,000 units per year it's going to take us 10 plus years to work through that, given the current construct of the housing shortage. So this makes this an amazing long-term tailwind investment cycle that we're in. And this was all predicated from the GFC that in 2008 that happened. Buildings shut down, but the housing demand didn't necessarily shut off. So we came to this in a massive deficit, 9, 10, 11, 12. We started building again in a relatively substantial scale, 12, 13, 14, and we've just never been able to catch up.
Okay. And I think for our audience, a lot of people when they hear land development, they think it's land banking. They think it's they have different, I think, notions of what land development is. Could you provide a bit of the overview of the general kind of big buckets of land development and let's hone in on the one that we're focused on and why.
Sure. So the first step in land development is what we call the entitlements, which is taking raw land that doesn't have any approvals whatsoever to build a housing community on it. So we do all of the work that's necessary, or someone would do all of the work that's necessary to get the land fully entitled, meaning all of the zoning is in place to build it, all of the engineering, water management, wetland delineation and management, stormwater management, water, sewer, et cetera. All of the work is done from an engineering perspective to get a housing community entitled and approved to be able to pull a building permit and actually develop the land. So that's one bucket that I've done in the past and that our company still does in one aspect. The second bucket is this very, very important bucket of actually developing the land. So taking the fully approved project and breaking ground on it, clearing the trees, balancing the land in terms of site work and excavation, putting in the infrastructure, meaning the water, the sewer, the power, the gas lines, the electricity, putting in the roads and the curbing and the street signs and the lighting, and getting what's called finished lots to builders, which are individual platted home sites that vary in size and configuration for a single family home community. So that's the land development component that's called horizontal land development, and that's what we focus on. The next and final stage to that is home builders buying finished lots with the roads already in place and then pouring foundations, building the homes and selling them to consumers. So that's the final step that we do not participate in. We really focus in buckets 1 and 2 and 90% in bucket 2, which is just horizontal land development.
Okay, great. And I guess when I mention land development, we kind of hone in on the development aspect. But in terms of investing in land, some people have the notion that it has to do with land banking, or maybe it's like tax lien based land banking. You probably have some exposure and experience in those. Maybe just briefly provide some of the kind of comparison and contrast, like why do we not go into those opportunities? Why are the land development components a better play?
Yeah, so land banking and that aspect of the business is really, look, there's large institutions. There's 50, $100 billion fund managers and companies that focus there and have that capacity. And we simply don't, we're not going to compete in that area. That's not, and those are very safe, stable yield investments that are frankly only really done at the high institutional level. So most of us just simply don't have an opportunity to invest there, and it's not something that that we can participate in. This component of the business is very much underserved, and there are not enough firms that are actually producing horizontal land development for the home builders in a meaningful way and in an organized and professional manner. It's a lot of mom and pop operations that operate locally and don't really have the infrastructure capacity and capital awareness to be able to structure deals and build horizontal land development at scale. There's a small handful of publicly traded firms that do this, but there's simply not enough. And so there's a great imbalance in terms of supply and demand here.
Okay, great. And James, you're the private equity veteran, and you love asking questions about risk, right? So I would love for you to like talk to Shane about risk, like all things risk relating to horizontal development.
Yeah, happy to. One thing that investors will see in the media currently, it's February of 2025, is while there's a shortage nationally in the U.S., from time to time there can be oversupply in one small region. So what we're reading about in some business papers is it's taking longer for, say, parts of Florida to sell entry-level homes. So that, I think, when I think of risk, is do certain areas get built up, and then how do you manage concentration risk?
Yeah, absolutely, James. Great point. And the answer is obviously yes, that can happen. And as we are seeing it in certain markets throughout Florida. And so how we manage that risk is by understanding the data. We're extremely data driven. And so for every market, we understand all of the phases of the market. Finished home inventory that's sitting on the market, um, homes under construction, land under construction, and land that is being permitted or already permitted, and then land that's in permitting process. When you understand that full spectrum of the life cycle of development, you really can get extremely sound data on how a given market or MSA is performing and is likely to perform going forward. And so there are several markets in Florida that are currently oversupplied in that regard, and builders are having to give 20 to 25% discounts on their product to get the inventory to move. So we're very aware of that and very keen to that. And so when we see that data, we're looking not only to what's happening now, but what is happening in 6 months, 12 months, 18 months, 24 months, so that we can understand, is there another market that's heading in that direction, given the data points we see on the categories of land development. And so even a home builder's still going to tell you there's no crystal ball, but when you have all of the data, you can at least make intelligent risk mitigation moves to limit your exposure in certain markets. And as a general premise, we work across 7 different states and across about 15 different MSAs. So we're also very cognizant of how we place our capital and our exposure into the different markets to limit overexposing in any given market and being exposed to that particular market having an oversupply challenge like you're seeing currently.
Yeah, and really the solution to oversupply is oversupply, because then developers quit developing there, and now you have an imbalance the other way. So using data makes a lot of sense to me. One feature I like about horizontal development, which you use, is how you manage risk between how you buy the land and sell the land. So when I first heard about horizontal land development, the biggest risk that came to mind was you could spend your time developing and putting all the services in, but who's going to buy it? Can you speak as to how you manage the risk of selling the pads when you're complete?
Yeah, absolutely. That is the biggest risk in any real estate venture. Your exit assumptions are always one of your biggest movers in your performance for your investment. So we love this business model because we obviously invest our own money, my capitals personally, in every deal we do as well. And I'm extremely risk adverse given the point of life that I'm at and what I've been able to achieve thus far. So the risk mitigation strategy that we love here is that we have the buyer locked in a contract for the takeout price and the exit for the finished lots before we ever buy the land. And we do that with a few key metrics in place. Number one, there has to be a corporate backed contract with an A credit counterparty, typically a top 50 national home builder or top 20 regional home builder for any given market that we're in. Number two, they have to give an earnest money deposit that's between 10 to 20% of the finished value of the lots that they're buying. And that money needs to be released and used in the capital stack for the development. So that's their skin in the game. And if they walk away or turn around or try to unwind, that money's locked in, and we have that inherent hedge and risk mitigation in terms of the capital stack and built-in equity in every single transaction. And then finally, we have a firm contract that says exactly what that finished price is going to be, an annual escalation on that price, and a very specific monthly or quarterly or annual lot takedown schedule that delineates precisely how many lots they have to take down and when, and an escalation on that, so that we're continuing to build that into our revenue streams. That's the risk mitigation strategy that I love about this business, is having that entire exit strategy mapped out and secured before we ever buy the land and proceed forward with the development.
So as an example, if you're buying land, say for $10 million, and the finished selling price was 20 million, the home builder would be investing between 2 and 4 million in the project. Do I have that right?
That's exactly correct. Yes.
Yeah. I always think about worst case situations as well. I mean, the probability is low, but as you know, I thought a pandemic was a low probability, which it is. But still, it could be a 1% chance or 2% chance something weird happens in a year.
Yeah.
So in a very worst situation where like there's another great recession and people just stop buying, homes entirely for a while. I'm assuming in that case the group that was going to buy maybe only buy part of the homes, and you're left with inventory. Are you able to develop the homes yourself in a worst case situation?
So we currently don't have capacity to develop ourselves in terms of the foundation to finish. But what we do in terms of mitigating that risk is we get a minimum of 3 other builders that would be willing and interested in building out the development should builder 1 drop out. And we get those indication of interest or LOIs from 3 other builders. And we feel like we're protected and mitigated there because we already have builder 1's deposit, and we're already diminishing our basis accordingly. So we can then turn around and sell that project and those finished lots for that much less to another builder and still complete the project.
Great. That sounds great. One other question I have is, generally we saw as interest rates increased, if fewer home buyers could afford the homes because mortgage rates had moved from say 3.5% to over 7%, and that's just due to inflation. We're seeing a situation today where rates are still, I think mortgage rates are over 7% now. Yeah. Again, in terms of who the buyer is, how does higher interest rates build up demand, pent up demand, and who is buying homes today, like demographically? Is it baby boomers, millennials? Where's the demand coming from?
Yeah, that's a great question. And the reality is it's different by region, different by MSA and location. I mean, you still see life events happen, right? Death, divorce, and other life events that cause people to need to trade real estate and change their homes. But you also see the continued migration patterns in our country of moving from north to south. And that people are still willing to, regardless of interest rates and regardless of what the macro conditions are, living in northern Ohio or New England this time of year versus a Sunbelt state is still desirable. And people will still, oftentimes in those northern climates too, sell their homes for much more than they will be able to buy newer homes for less down south. And so they get a climate enhancement and they get their dollars perhaps stretched a bit farther. And so you're still seeing a lot of, move up buyers and Gen X and millennials and baby boomers that are moving out of their current living situation into a more southern climate and southern living situation. And that's really across the spectrum from the age of 30 to 80. You're still seeing that migration pattern. Different cities are going to have different makeups of which one of those categories is larger than another. For example, in the Tampa market that we study, a submarket of St. Pete is going to have a lot more of 30 to 40-year-olds than a submarket of Naples, who's going to have a lot more of the 50 to 75-year-olds. So it really depends on each individual local community in terms of what that demographic looks like.
Yeah, I think the housing market's fairly tight still, because we saw with the LA wildfires, especially with Palisades, people couldn't find a place to live. Like they were looking for homes to rent, it wasn't there.
Yeah.
So I think there's lots of demand building, and there's cycles. So as rates one day go down, I think you'll just see a lot more selling and demand for housing as well.
Absolutely. Yes.
Yeah. Shane, I want to go back to talking about your clientele a little bit. So the buyers of these finished pads. So you mentioned you work with the top 50 home builders in the country. So some are public, some are private. Um, could you provide an overview of who these, companies are and why wouldn't they have developed an in-house capability to do this themselves?
Yeah, great question, Al. So, they're all the big names that everyone's heard of. It's D.R. Horton, it's Lennar, it's Centex, it's, Century Communities, Toll Brothers, et cetera. I'll just go look at the Builder Top 100 and you'll see all their names. And so why some of them do self-develop. So let's be clear about that. They do self-develop. But more and more of them, following the top leaders' position on this in the industry, are taking what's called a land light model, especially the publicly traded ones, and that is the model of keeping the inventory off of their financials and off of their books, and only closing on them and monetizing that purchase to be able to build a home and sell it. So when they get a finished lot, it's on their books. They build a house quickly, they sell it. It's usually on and off their books in 12 months or less. That is a metric that a lot of national home builders and publicly traded firms adhere to for financial performance and quarterly earnings reports, and driving shareholder returns from a public builder perspective. So we sit very well in that model because we put it on our balance sheet and we take the land on our books and we build out that infrastructure and let them monetize it precisely at the point in time when they do what they need to do best, which is they get revenue for selling homes. Everything prior to the building of the home and the selling of the home, they're happy to off shift and can still control the process via a forward contract with us. So they have control rights to the pipeline, but it's not being done on their balance sheet. So that's a great value add to the publicly traded home builders and large regionals. It produces another layer of execution risk that they have to manage as well, that they don't have to manage when they work with a third-party firm like ours.
Great. And what about with the scaled but private home builders? Do they have the same
Yeah,
metric?
great point. Thank you, Alice. Yeah, the scale for private home builders, they have financial capacity, but they don't have unlimited warehouse lines with BlackRock like some of the nationals do, and they're not using some of those similar financial capacities that publicly traded firms do. So they have a capacity issue. They just simply can't self-develop enough to meet their pipeline and personal and their company's growth needs. So they bring on a firm like ours, and for example, if a firm could develop 6 communities themselves, but they want to grow to be able to develop 10 communities over the next 2 years, they simply can't do it because there's not enough. It's too much risk for them to continue to build out their infrastructure. So they partner with us and contract with us to build those 4 communities for them. And so now they're able to keep their infrastructure and their personnel and their overhead the same, but increase that capacity by working with a third-party firm to grow their growth goals without needing to add anything else in terms of risk to their internal profile.
Okay, great. Yeah, that makes a lot of sense. Yeah, so James, I know that you love studying markets in depth. Do you have any other demographic or outlook type of questions for Shane as
I'm just
we?
interested, Shane, which regions are you most bullish on currently for development?
Yeah, we really are extremely bullish on Texas, North Carolina, South Carolina, um, Tennessee, specifically the Nashville market, um, Florida in key markets, in certain markets that we believe in. Sort of Tampa is one of them, even though there is some oversupply that's happening in and around the Tampa market. Orlando, we like the Panhandle region. There's a lot going on there, but also the East Coast between the Space Coast down to West Palm. We think that coastline is going to continue to expand and grow dramatically over the next 10 years. So we're pretty focused there. That Orlando to Ocala market, we think is really, really hot as well. We really like the demand that we see there. But it's really the major markets in the Carolinas, Florida, Texas, Tennessee, and we also found some interesting pockets in Kentucky, which was not necessarily on our radar and is more of a secondary market. But there's a severe supply-demand imbalance there, with builders wanting to grow their capacity and job growth happening in those key MSAs. And there's simply not enough development partners to help them grow there. So we're finding a really interesting niche in that market as well.
Yeah, no, that's great. I get pitched investing, across North America, and there was one opportunity that was given to me, which was a 7-year subdivision. So it would take 7 years to get the land entitled and permitted, and then built out in different phases. And just as an investor, the longer you're in something, there's a higher degree of risk it can change. Can you talk about time duration and how you manage the time risk, both from a contract perspective in terms of how long it takes, as well as how often are you offloading inventory? So let's say you have a 2 or 3, say a 300 home subdivision. Do you have to complete all 300 pads first, or is it sold off over time?
Yeah, that's a great question, James. And that's frankly another part of the risk mitigation strategy that I absolutely love about this business. So to answer your first question, we have an internal metric that we use, and our debt partners are willing to go farther, but we've determined that we're not interested in doing more than 36-month projects. So all of our projects are 36 months or less. We're heavily weighted now towards projects that are closer to 24 months, just to get that recycling of capital and that opportunity cost flywheel spinning a little faster. So 24 to 36 months is generally the timeline and horizon for every one of our transactions and communities. And the thing I love about this business from the risk mitigation strategy is, let's say it's a 300 lot project, and let's say it takes 36 months for the takedown. We will generally be building expense to a point where we have a max exposure on our sources and uses, where we're really not going above about a 50 to 55% LTV on our loan product. So it keeps it very low risk. And the reason is we're building expense, and we get a certain tranche of, let's say, 50 lots completed, and then we get a revenue hit from the builder, and they take that down, and then we continue to build the expense of the next section of road, or the next pod, sometimes as it's called, and then the next revenue comes. And so we're constantly we have an initial expense build for the land takedown and acquisition, but then we're continuously lowering that basis every quarter as we complete the project. And so that is really driving down our risk and our exposure in the deal as we go. So it's not that we have to incur all of the expense and then get all of the reward at once. We're leveraging that to build our revenue takedowns in concurrent with our expense build, to be very efficient with our capital and our exposure.
Yeah, I really like that.
Yeah, we do too.
Yeah. Yeah, speaking of fast changing macroeconomic conditions, let's talk about the tariffs. So the new government just imposed a 25% tariff on Canada, where James and I are from, and Mexico. So does that impact land development at all?
Yeah, that's a great question. I mean, it tangentially could affect land development. It's really, it's very market dependent in terms of the supply of let's say in this case lumber, which is I think the biggest, concrete from Mexico, lumber from Canada, and in the South where we focus, I think there's enough U.S. based, Georgia Pacific comes to mind, for example, for softwood suppliers and local, concrete suppliers, where there could be some mitigation of cost to the home builders. I think it could affect the horizontal land development practice in terms of the builders wanting to put what's called downward pressure on their acquisition basis for finished lots or for horizontal land development. The flip side to that, though, and the counterpoint to that, is that there is still such an undersupply of finished lots to home builders. And you can pull any national home builder or any home builder in any given market, and that will be the case. And so our product is really at a premium. And so our land basis and the work that we do to put in the roads and infrastructure is still a relatively stable commodity, if you will, because there simply is not enough production. So we will, in any given community, we will have 5 or 6 different builders that are bidding to be able to give us a contract to take it out. And we obviously bid them against each other and see who the highest and best is going to be. And I don't see that relationship to our business model changing very much, even given the light of the tariffs. It might make some builders be a little less aggressive in terms of how they want to grow in certain markets, but our product line is still extremely valuable, and I don't think we're going to see a ton of downward pressure accordingly.
Mm-hmm. Yeah. Any thoughts on that, James?
Yeah, it's complex because our world is integrated, so much that it's hard to, to work out exactly what happens. But generally, if there was a slowdown, then you're going to have lower GDP growth. And if you have lower GDP growth, that means the Fed reduces interest rates, which then means buyers now can afford to buy more homes. So you can have dislocation, but ultimately there's a solution in that. So if there is a bit of a slowdown, interest rates come down, and then the buyers can buy more again. So it would offset.
Yeah.
Yeah, we saw
Yeah.
that during the pandemic in a big way, didn't we? Like
We did.
interest rates went to zero, and suddenly, everyone loved real estate. And remember, with anything like a tariff, say on lumber, well, single family homes is only one portion of it, or cement for that matter. I mean, the entire construction industry, which builds everything from retail centers and government buildings and multifamily, would be impacted. So if it's impacted harshly, then interest rates would have to come down, and just to level it off.
That's exactly right.
Yeah. Yeah. So I don't see much risk in that. I see, if you look at the pandemic, there was a lot of panic for a couple months, and then it normalized. And we saw that in 2008 as well. There was panic for a couple months, and those were severe, much more severe than the tariff situation. And then everything normalizes. So this is, they haven't even happened yet. In Canada, the tariffs hit tomorrow and Tuesday. But likely, a month from now, it's old news. We'll see.
Yeah.
Mhm. Yeah, so I guess we're close to the end of the hour. So James, you and I have an 8-page due diligence process. So any other questions relating to risk or due diligence that you would want our investor base to know?
Yeah, so on due diligence, we look at each project. So as Shane brings us an opportunity, we're looking at the data as well, just like Shane does. And Shane, shares his source. If I recall, Shane, you spend hundreds of thousands of dollars on data, and so it's good data, it's thorough. So that's the first risk, is just what we call market risk. And so we do work on market risk. The next issue is really execution risk. The nice thing about working with the same developer over and over again, we only have to really look at that once and then periodically checking there hasn't been changes to the organization. Uh, but really success in investing is based on people. And Shane is good people and he has good people. So that's the biggest reason I find investments are successful is you have a really strong management team. They have the track record, they have the competency, and they know how to solve problems because every business there's always going to be problems. Today it's a tariff, but the business community is very very versatile and they'll figure out a way around it. And so Shane's that type of person.
Okay, amazing. Yeah. So Shane, final questions for you. You're already a tremendously successful entrepreneur. So what keeps you going? Like, what is driving you today? What makes your heart sing? And what's the legacy impact you hope to create?
Yeah, well, I love that question, Alice. So, um, I truly love this business. I'm passionate about it. How I've always been in housing, and as I've evolved through my career, I now know that my path has been the way it has been for a reason. And so I've been placed in this very unique position where we get to develop communities of housing, which is a fundamental human need. And I take that responsibility very seriously. We've also, been fortunate enough to manage and take on hundreds of millions of dollars of investor capital through the years. And I take that responsibility extremely powerful and serious as well, because a lot of my family members, right? So where I get up every day with the passion to excel because I feel like I've been given a great responsibility. And so I'm proud of the fact that we develop housing in America, and that we get to work with amazing people in doing that. And so I feel like we're meeting a fundamental human need, and that fills me with joy. Beyond that, we do a lot of corporate giving. It's just inherent to who we are, and helping every community that we work in. I think this year specifically, you're going to see a lot of press releases about what we do and how we do it in that regard. We have ESG philosophies, and they're more than philosophies; they're action items that we take up on a project basis. And so, giving back and producing positive effects in the world is really what drives us.
Okay, amazing. Thank you, Shane. It's an honor for James and I to partner with you, and we look forward to scaling this mission together. So,
Yes,
yeah,
absolutely.
thank you.